In this short video, I'm going to explain about buy-to-let mortgages. Hi, my name is Mark Lloyd and I'm co-founder of Property Master Academy. Firstly, we need to establish whether you qualify to get a buy-to-let mortgage. In order to do that, there are three main questions that need to be asked. Firstly, whether you're a homeowner or not. Secondly, around your credit status. And thirdly, about your income. Now, whether you're a homeowner or not shouldn't really matter with regards to a buy-to-let mortgage, but if you are a homeowner, it certainly does give you an advantage. If you are currently renting and want to get a buy-to-let mortgage, then you will need to speak to a good broker. The second area is around credit status. And what I mean by this is whether you've missed any payments on anything, have any county court judgments, and so on. If you have, you will definitely be refused a buy-to-let mortgage. It doesn't matter how much you try and explain whatever happened with those missed payments. Because the way a buy-to-let mortgage is operated, it's a computer that generates the answer. And the third area is income. Now, some lenders ask for a minimum income of £25,000, but some lenders do not. But at the end of the day, the property is not based around your income. The property is based around the property's income. And the amount you can borrow is based on a factor between the purchase price, the amount you want to borrow, and the income from that property. Because the mortgage is based on the property, there are two factors that come into consideration: the purchase price, or the value of the property, and the rental income. So how much could you borrow? Usually you can borrow up to 75% of the purchase price or valuation if it's a remortgage. Now, I say usually because it depends on the rental being achieved for that property, because the rent needs to cover the mortgage by a certain percentage. Now, if you're buying in your own name, that means the rental income will need to cover the mortgage payments by 145%. If you're buying in a limited company, that percentage is 125%. So what that means is, if your mortgage payment is £100 a month, the rent for a limited company must be in excess of £125 per month, and if it's in your own name, it must be in excess of £145 per month. So the next question you need to ask yourself is, do you have a repayment buy-to-let mortgage or an interest-only buy-to-let mortgage? Well, most investors choose an interest-only mortgage, and that's because you receive greater cash flow per month because you're not having to repay the capital. So the next question you need to establish is it going to be a repayment mortgage or an interest-only mortgage? Now, most investors choose an interest-only mortgage because that results in greater cash flow per month. But of course, you're not repaying the capital. So what do you do then at the end of the mortgage term? You could, of course, sell off the property or pay off the mortgage. But there is another alternative, because an average mortgage is 25 years. So you could remortgage, because over time, the value of mortgage debt decreases because of inflation. So what do I mean by that? Well, you may have heard that on average, property prices double every 10 years. So if we take an example of a property purchased for £100,000 with a 75% loan to value mortgage, so in other words, a £75,000 mortgage, in 10 years' time, that property should be worth £200,000. But of course, the mortgage remains the same. It is still £75,000. So you've created that equity. That's what I mean by inflation eroding debt. Now we need to look at which structure will you buy the property in. In other words, will you buy it in your personal name, or will it be in something like a partnership or a limited company? Well, this is a tax question, really, and something you need to discuss with a good property accountant. They're the people that can advise you. I certainly can't. All I can tell you is that I have properties in my sole name, in a partnership name, and more latterly, because of tax changes, in a limited company name. But you must seek advice on this issue. So now let's take a look at the mortgage options available. Well, there's three main mortgage options: fixed, tracker, and variable. Now, dealing with the first one, well, as the name suggests, fixed means you're paying a fixed rate over the term of that particular mortgage. And that may only be a couple of years, 2 years, 5 years, and there are now some available at 10 years. And that means that rate will not change during that period. The second element is a tracker mortgage. Now, what that means is it will track a particular interest rate. It may be the Bank of England's base rate, it may be the lender's own particular base rate, or it could be something like LIBOR, which is the London Interbank Offered Rate. Those are the three main rates that are tracked in the market. And the last one is variable. This is where the rate is determined by the lender themselves, and they can charge essentially whatever they like. And that's often the default rate once a particular mortgage offer has ended. Now, when you're looking at mortgage offers, and particularly the mortgage rates, don't be swayed by the headline rate, because there are always hidden charges. Virtually all mortgage lenders charge a fee which is added onto the mortgage. That can be anything from 1% to 3% and sometimes higher. So it's something you need to look at and calculate within your figures. And the last thing we need to look at is lending criteria. Does the property you're buying fit the lending criteria for the lender? Because surprising as it may seem, not every lender lends everywhere in the UK. So that's why it's really, really important to use the services of a good mortgage broker, and preferably one that has experience of dealing with investors. I hope you found this video useful. If you have, please hit the subscribe button below and you'll get notified of other important videos as they arise. Thanks for listening.